So, hi Audrey. Today we are gonna do a case about technology. So let me introduce you to the case first. This case, our client is a data backup and disaster recovery company. Its primary headquarters is in Boston. Its client service department is in South Carolina, and its department is split between Texas and Ukraine. To expand its product offerings, reach, and revenue, our client is considering purchasing Cloud Call, which is a cloud backup provider headquartered in South Carolina. It's headquartered in Southern California. Our firm has been hired to evaluate this potential acquisition. How would you begin considering this deal?
Okay, so firstly, may I just clarify the background of this case? So our client is a kind of company that focus on the data back and focus on the data recovery, and its headcount is in Boston, and their other service department in South Carolina. And right now they want to acquire, or should say merge, another kind of company called Clowen. Which is located in also located in South Carolina. So our client wants.
So the company they are trying to acquire, not merge, acquire, is Cloud Call, and it is a cloud backup provider headquartered in Southern California.
Okay, so those two companies are focused on the same side of this industry, right?
So our client is. They do a physical backup devices, whereas Cloud Call is a cloud backup provider.
Okay.
So they both do data backup, but in different ways.
So Cloud Call is for cloud backup.
Cloud, yes. Our client does the physical ones. So the physical, so you can have a giant physical backup thing in your company that's provided by our client.
Okay, got it. So our client target, they want to see that what they should do with this acquire, or whether or not they should do this acquire.
Yes. So they want to decide whether or not they want to do this acquisition. And our question is, how would you begin considering this deal?
Okay, so our client target, whether or not they should do this deal. And do they have any expectation for this deal? What kind of profits or gain customers and etc.?
They don't have a specific goal they want from this deal. They just think this might be a good idea, and we are supposed to tell them these are the risks and these are the benefits of the deal, and whether or not they should do it.
Okay, so my job is to help them to clarify the benefits and maybe the risk for this deal, and to help them to make the suggestion that whether or not you should do this deal, right?
Yeah.
Okay, got it. And I still have two big questions about their company themselves and the companies they want to acquire. So firstly, I want to know more about our clients. So what kind of product they provide? Only for the data backup or any other things?
So our client has physical backup appliances that can be launched on their own client site. And then they also have softwares that their clients can deploy on our clients' devices. So they have appliances and they have softwares.
Okay. And what about their customers? To business or to customers?
They sell to business, so it's a B2B model.
Okay, sell to business. And what their channel to sell this kind of stuff? Only online, or they have their own physical store?
Because it's B2B, so I don't think they're gonna have a physical store. It's more like a liaisoning with their clients who regularly buys them, or try to reach out to the departments of their potential new clients, those kind of things.
Okay, and the final question for our clients about their financial situations. Do they have enough money to prepare for the sale?
We are not too concerned about that for now.
Got it. And also I have another questions for the company they want to like acquire. So for the cloud back, so what kind of like product exactly that is provided?
They provide like a cloud backup service, so also to business, and they do sort of like a cloud backup, like those kind of things like OneDrive and all your cloud services, but for business.
Okay, so do they have like the cross function between those two, like cloud backup and the physical backup? Is there any connection?
Yeah,
between
basically
those?
you can back up your data physically and on the cloud. The like the same sort of the same function for the clients to back up, but by different, they achieve the same goal by different ways.
Okay, so which means that clients might need those two services at the same time, right?
It depends on how the company thinks, right?
Okay,
Like
so
you can prefer one over the other, or you may want to be safer and you're gonna have both.
okay, got it. So which means that the clients for those two companies are maybe have some like same for same group, but they're like slightly different depending on company's choice, right?
Yeah, so there's gonna be some overlap in what they provide in their client base, client base.
Okay, but literally they are like enlarge their client group, right?
They could.
Okay, got it. So could you please give me several minutes to write about like the framework for solve this kind of problem? Okay. Okay, so I have finished my like basic framework for this kind of case. So I think that in this case, my hypothesis that is a kind of good deal for like both the clients. And to prove it, I think my frameworks can be divided into 4 large segments. So the first part, I would like to discuss about the market attractiveness. So there can be like the market size for the cloud backup market and also about the market growth. And also about the profit margin for this industry to see that whether or not this deal can help our clients to make more profit in future. And for the second part is called the company attractiveness. So in this part, we will mostly focus on the cloud backup companies itself. So first, it will look at their like market shares and their profitabilities, and also does this company have the competitive advantages, like what kind of license or product they produce, is it quite specialized compared to its competitors. And for the third part, we'll discuss about the synergies, both on the products and for the clients. So like maybe the fourth part, we'll talk about the risk and maybe the regulation part for this deal. So above those 4 parts, I think it will help our clients make the final decision. So if you think that this framework is like correct and like it's clear, so like may I just follow this framework?
Okay, very good. That's a very good framework. Do you mind expanding, explain a little bit more of like what kind of synergy and risks you're going to consider?
Okay. So like what about to start with, as you have mentioned about like the synergy. So firstly, we'll look at the companies and then the synergies, or like go to the synergy itself directly.
Sort of like just do like a brief, so like just at the first glance, we are not in the case proper yet. Just at first glance, what kind of synergies or what kind of risks can you think of?
Okay, so for synergy, I think first, it will help those two companies to share like the customers, and also will help them to enlarge the sales per unit, because they can like persuade their customers to buy those two products at the same time. They may have provided discount for their customers, and in this way they can like generate actually more profit. And also, I think for the second part for their products, so because they have some overlap to those kind of products, to some like new technology, and those two companies can like trade or like can like improve each other's. So I think for customer side and for product side, it might contain some synergy.
Okay, good. What about risks?
And just like a brainstorm, I think risk is that because this kind of overlap, it will also have like on the customer side will help you to like lose some like deals because client may choose such one of them. But we can like use some like in the marketing skills to avoid this risk. And for the second one is that because like this deal have like a lot of like money for the investment, our clients may need to consider about their financial situation and whether or not they can bear such kind of like investments to keep their cash flow health. And for third one, it's about after like finish the sale, that how they will like deal with the relationship with these new companies, including their labor, their like business culture, their like running process and their trust. How to like help those two companies to like quickly get familiar with each other.
Okay, very good. So now let's move on. My first question for you actually is, how would you value Cloudco? So what is the value of this company?
So you mean the value method?
Yes, so let's do a valuation of this company.
Okay, so like just a quick name each kind of like method. So firstly, can use like DCF model to estimate the value for its companies. And also I think that they will kind of find out the advantage of companies to like make the comparison about those kind of like companies' price. And also for a third method, is to like see the multiple factors combining to their like profits and their like estimated price to count about those kind of like price.
Yes, so I think the DCF method would be good in this case.
Okay, got
Let's
it.
just use DCF.
Okay.
And
So
I've sent you an exhibit about some data that you might need.
okay, got it. So this is kind of like, could you please give me several minutes to like make the calculation about this kind of chart?
Yes.
Okay, thank you. Like first. So what does this like tier 1 or tier 2 or tier 3 means?
So basically our client has three, you can think of it as three different kind of products our client Cloudco provides.
Okay. So like here are the revenue for, okay, got it. So these are kind of like three different kind of products, or
so like because the customers of Cloudco have different demand in terms of how much space they need. So they have Cloudco has three tiers of pricing. So based on the data size, they have a different price.
Okay, so they have like different price. So what is the discount rate for the company in this situation?
So the hurdle rate is 13% and the expected growth rate is 3%.
Okay, got it. Okay, so for DCF, the first step is to calculate about the profit for those like tier 1 to 3s based on this chart, and then use this profit and the 100 rate or the 100 rates minus the expected growth rate to get about the estimation for this company. So this is the like the framework of how to count this value for this companies. Is that like clear and correct?
Yes, please go ahead.
Okay, so what are their like cash flows per month for those like tier 1 to tier 3?
Cash flow per month for the tiers?
Yes.
We have the price for tiers.
Okay, got it.
So tier 1 is $10 per gigabyte per month. Tier 2 is $8 per gigabyte per month. And tier 3 is $5 per gigabyte per month.
$5. Okay. So are they have like two different kind of like product, because like there are terabits, but you have said about the gigabit.
So terabits is TB, gigabyte is TB. So 1 TB is 1,000.
Oh, got it. Sorry. So for this kind of like first step to count about the profits. So firstly, we'll focus on tier 1. So like the because it's like chart is show about like tier TB, so we count about it turn into GB. So like for tier 1, the GB they sold is 10,000, and because the price per GB is 10, so we have count about the monthly profit is equal to 10 times 10 equals to 100,000.
Yes.
Okay, and for tier 2, use the same method. The GB they sold is to 25,000, and for the price per GB is 8. Then times them together, so the monthly profit is 200,000. And the same method for tier 3. So GB sold is 40,000 and the price is 5, and times them together, they are like also 200,000. So like plus them all, 100 plus 200 plus 200. So the sum profits per month is equal to 5,000.
5,000.
500,000.
Yes.
Okay, per month. And I think to account about like, because I think these situations need to count about the yearly profits. So use like 500,000 times 12, which is equal to $6 million.
Yes.
Okay, I think the unit is dollar.
Yeah.
Okay, got it. And we have finished about the first step, account about the profit. And then, as I have mentioned before, the next step is use the handle rate and the expected growth rate to count about the valuation price. So I think the formula is use the cash flow, as I mentioned before, the $6 million per year, divided by use the handle rate minus the expected growth rate, which is 13% minus 3% equal to 10%. So 6 million divided by 10% equals to 16 million.
Yes, that's very good. Okay, very good. So now let's move on to the next question. Assuming that we will expect a standalone value of 60 million, how much do you think Backup Co, which is our client, should be willing to pay for Cloud Co? So we've just considered the standalone value, and now let's consider the combined value.
Okay, the combined value. So could you please like clarify what does it mean by combined value?
So like we need to think about the additional value and the 60 million we've just estimated, and think about what is the price that Cloud Co, the client Backup Co should be willing to pay. So sort of what is that maximum price that they should pay?
Okay, got it. So so this stage we just count about the additional value, right?
Yeah.
Got it. So in this chart, the revenue increase per gigabytes sold means that after this, like they acquired, that the increase will have, right?
So after, if the acquisition is successful, this increase will happen. Okay,
got it. So in order to like count about the added value, the final profit from this like acquisitions. So my basic framework is that profit equals to like revenue minus cost. So this chart, I will firstly count about the revenues generated from like this deal, and then I will count about the cost.
Okay.
Okay, so like for first step, for count about revenues, I will count about like the revenues generated from like those 3 tiers like sold. So for tier 1, there is like we still use like the same data as the exhibit 1, right?
So you can think of it like the revenue. So the exhibit 2 is about the revenue, like sort of the revenue increase. But the volume, you can still use the exhibit 1 volume.
Okay, got it. Oh, that's clear. That makes sense. So for tier 1, the volume is if I could change the units, it's sold the 10,000 GB. So times 1 equals to like $10. $10,000, sorry. And for tier 2, use the same method, use like 25,000 GB times 1 equals to $25,000. And for tier 3, same method, use 1 times 40,000 equals to $40,000. So plus them all, it will be like $75,000 increase per year. This is for revenue for our clients if this still is success.
Yes.
Okay, so I hope we have finished about the revenue side, and then we'll move to the cost side. So for the cost energy, it's like a revenue for the total revenues, like right, the on the chart, 10%, 15% is focused on the total revenues, right?
So that's the yearly total revenue.
Okay, so
year.
Okay, so it's like the revenues for like I have a count about $75,000 if that numbers times 2.
75,000, is that for a month or a year?
Okay, I got it. Sorry. So 75 is about like monthly. So I need to like times 12, which is equal to so $900,000.
Yes.
Okay, so like you say 900 times 900,000 times 10%, which is equal to 19,000. And for the head count, use 900,000 times 15%, so which is equal to 135,000. And then for R&D costs, use 900 times 5%, which is equal to 25,000. So plus 45,000, sorry. So plus them all, 90 plus 135 plus 45. So there are $270,000.
Yes.
Okay, so for your final step is use the revenue minus cost to count up the profits. So there are 900,000 minus 270,000. So which is equal
actually, Audrey, the cost synergies are the savings that they by merging. So both the revenue and you add them together because you are increasing your revenue and you are saving on your cost.
Okay, got it. Okay, sorry. So like so plus them together. So there are 900,000 plus 270,000. So which is equal to which is equal to 1.17 million.
Yeah.
Yes.
Yes.
Okay, got it.
Yes.
So I think that there is a profit like can generate from this like deal.
Yes, but what is a combined value of CloudCo?
Okay, so like could you please give me a hint about how to count this thing?
So basically you're still using the cash flow model.
Yes.
And but but you're changing how your cash flow is calculated. So previously you were only calculating the company itself. And now you're calculating a combined cash flow, which is the cash flow after margin, after acquisition.
Okay, got it. So still use like the same DCF like count method to count about this combined value, right?
Yeah.
Okay, so I will like plus the additional value, plus the like the values that I felt like counts at the first stage is 6 million plus 1.17 million, so which is equal to 7.17 million. So use the same DCF method, use this account to divide it by 13% minus 3%. So the final result is $71.7 million. So this is the combined values, the valuation for the combined values for the company.
Yes, that's very good, very good. So now we have come to the conclusion part of the case. Now you've met our client, and what would you say to them?
Okay, so could you please give me 30 seconds to count about like the result I have like collected about?
Please.
Okay, so I'm prepared for this presentation. So I think to the final suggestion for our clients is that they should do the sale to acquired the cloud-backed companies. And I think it will help them because it will help them to bring like more like synergy revenues from this kind of deal. And I think that the estimated price, the highest acquired price is 71.7 million, and if we only count about the profit for this company, it will be $60 million. And for the next step, for the risk, I think our client need to consider about this deal is how to hold, how to like deal with the overlap for their own customers, and avoid like the missing this kind of like customers. And also, I think you need to count about how to like help with this kind of company to get familiar with each other, to like make this company runs normally. And also, companies need to consider about the financial situations, the cash flow for their own companies after finish this big deal. And I think that the next step is to do like firstly do more like due diligence for the companies they want to acquire with, and also like to sign up a negotiation with the management team from this cloud-backed companies. So I think that overall this is suggestion for our clients.
Okay, very good. That's the end of the case. Congratulations.
Thank you.
Yeah. So how do you think about like your performance? How do you think you did?
Well, actually, I think that for first step, when I write about the framework, I think like actually I do not have like think I can control this case, because I do not like figure out like which direction that might be for this control like this case my goals. So actually the process is like quite beyond my expectation. I thought it might consider more about like the customer overlap and etc. and give me more data about the profitability, the product and etc. But only about the calculation for the valuation price.
Yeah, it's a very, very numerical case. I have to be honest, that's why I was asking you, like, did you find, like, have you looked at this case yourself? Because I've never seen such a case before. It's a very, very technical. I think the probability of such a technical case coming up is actually quite low, but it's good practice that you have got this one. So it was a surprise. I think your framework was actually okay. Like it was a very standard M&A framework. So definitely you can continue to do that. And it was very good because when the case go into an unexpected direction and you just followed, so that was very good. So as I probed you during for your framework, your synergy and risk, that's where you can give 1 or 2 examples instead of just saying we're going to look at synergy and we're going to look at risk. So sort of just giving 1 or 2 lines of examples will be good. Another thing at the start of the case is that I feel like you were asking too many clarifying questions. Like it is a good thing to know that to make sure you understand the case and grasp everything. But I feel like we spent a bit too long at that part of the case.
Okay, got it.
Okay. And then for your calculations are very good. And I really like how you presented your calculation. It was very clear, and you always your numbers were very like, this is a number that you give the intermediate numbers at a very good pace. So it was very easy to follow. I think one thing you can improve here is that when you receive an exhibit, it's worth to sort of spend time reading it and then like tell me a bit about what is the exhibit. So for example, for exhibit 1, you can just say, so this is a chart of the revenue in 2019 in terabytes, and divided by quarter.
Okay.
So this is just to sort of check your understanding, make sure like there's no like basic misunderstandings of the exhibit. I think it's a good practice.
Okay.
And also, so actually there's a third part to this case, but we didn't have time for it. So normally a case is 20 to 30 minutes, and that's about how much we spent. So there's a third question on sort of what is an M&A structure. So basically, if you want to set up an M&A team, what's the composition of the team? I say this because I feel like we can speed up the first 2 questions a little bit, then we would have had time for the third one.
Okay, got it.
Yes. Just try to be a little bit faster. Yeah.
Okay, got it. And one last question is that like for the clarified questions, that how can like ask about the accurate questions and find out about the right directions at the first time of really hurrying about this case?
So what I did was that I had a list of, so I was looking at all the case practice I did, and I had a list of questions that were most frequently appear in the case books. And so like, for example, that could be like, where is this company doing its business? What is the time frame of this case? Do they have a specific goal? Those kind of things. So like, I sort of have a checklist in my mind of what are the kind of questions I could ask. And then on top of that, sort of be flexible with it, because there might actually be parts of the question that I don't understand. That's the priority. So sort of scan through that list and figure out like 1 or 2 or 3 most important, most relevant ones.
Okay, got it.
Yeah, but like I can't tell you like this is the most relevant one, because every case might be a bit different.
Okay, got it. Yeah. So like the most important thing for solving the case is like logically and confident, instead of like getting a correct answer, right?
Yeah, it's about the process. It's about the process. So how you communicate, and also like how you communicate. So think of this like a actual workplace, and then you are discussing with your colleague what is your next step. So you have to be very open to the information they give you, but also critical. You have to be very flexible, and you have to be able to keep the bigger picture in mind.
Okay, got it.
Yeah. So for example, when you were talking about your conclusion, in our introduction, we said that our client is considering this acquisition because they want to expand their product offering, reach, and revenue. So in your conclusion, you could have linked this back to the introduction and say that, okay, it's expanding their offering, yes, because it's a related but different kind of service. It's expanding their reach, possibly because they are headquartered in a different place. So we could expect that they have more customer base in Southern California, and that could sort of help bring over some of our business. And do they expand the revenue from the calculations? Yes. So that's the kind of bigger picture that you could have kept in mind.
Got it. Thank you so much for giving me such kind of like valuable suggestion.